The banker pushed the loan application across his desk. Warren Kozlowski didn't touch it, didn't even look at it, just kept his hands folded in his lap and said 5 words that would haunt Jack Morrison for the next 3 months. "I don't need your money." Morrison blinked. Twice. In 15 years of agricultural lending at First National Bank of Akron, Colorado, nobody had ever said that. Not once. Not in this building. Farmers walked through that door with their hats in their hands and their books in their pockets, and they needed money. That's why they came. That's how it worked. But Warren Kozlowski sat there in clothes that looked like they'd been mended twice, driving a truck that was 12 years old, and he was turning down an operating loan. Morrison tried again. "Mr. Kozlowski, I've reviewed your application. You're farming 1,600 acres of dryland wheat. You've got maybe 200 head of cattle. The spring planting is 6 weeks out. You're going to need seed, fertilizer, fuel, parts. That's $30,000, maybe $40,000 right there before you harvest a single bushel." Warren nodded. "That's about right on the numbers. So you understand." "I understand that I don't need financing." Warren stood up. "But I appreciate your time, Mr. Morrison." He walked out, left the loan application on the desk, left the banker sitting there with his mouth half open, and a stack of paperwork that suddenly meant nothing at all. This happened on February 14th, 1978, Valentine's Day, the day Jack Morrison started to realize he didn't understand farming as well as he thought he did. What I'm about to tell you is reconstructed from bank records, county documents, and interviews with people who were there when this played out. I've combined details from multiple cases across the High Plains in the late 70s and added narrative elements to create a complete story. But every financial principle, every piece of equipment mentioned, and every lending practice you will hear about comes straight from documented agricultural banking history of this era. The names are changed, but the economics are real. And the lesson? That's real too. Let me take you back to Washington County, Colorado, in the winter of 1978, and show you what happens when a banker makes assumptions about a farmer he's never bothered to actually know. Warren Kozlowski had been farming outside Akron since 1964. 14 years on the same place. Section and a half, 960 acres, that he bought from his uncle who decided Montana looked better than the eastern Colorado plains. Warren had added 640 acres more in 1971, leasing from a widow in Denver who'd inherited it and didn't know what else to do with it. Nobody in town knew much about Warren. He came to the farmers' co-op for fuel and parts. He sold his wheat through the elevator. He bought cattle at the auction when he needed them and sold them when the time came. He didn't drink coffee at the cafe. Didn't hang around the co-op swapping stories. Didn't go to the Cattlemen's Association meetings or the County Farm Bureau gatherings. His wife had died in 1969. Cancer. After that, Warren became even quieter. He had a daughter in Fort Collins at Colorado State, studying something. Education, people thought. Or maybe nursing. Nobody was sure. Warren didn't talk about it. The farm itself was neat, but not fancy. Steel buildings instead of with sheds. Fence lines that were straight and tight. But no new paint. No landscaping. No sign of money being spent on anything that didn't directly make the operation run. His equipment told the same story. A 1966 International 1466 tractor that he bought used in 1970. A white 2-155 he'd acquired somewhere around 1974, also used. The white was the bigger tractor, 155 horsepower, 2-wheel drive, good for heavy tillage work. The International was older but reliable, perfect for lighter jobs, and running the grain auger. Both tractors were maintained like surgical instruments, clean, serviced, operational, but neither was new. His combine was a 1972 John Deere 6600, not the latest model, even when he'd bought it. But in 1978, it was still doing the job. Warren had put it through 6 harvests, and it showed every one of them. The truck was a 1966 Chevrolet 3/4 ton. Blue paint faded to gray in spots. Dents in the bed. But the engine ran and the transmission shifted, and that's all Warren seemed to care about. To someone like Jack Morrison, who spent his days looking at balance sheets and calculating debt-to-equity ratios. Warren Kozlowski looked like exactly what he appeared to be, a small operator, probably over-leveraged, definitely undercapitalized, living season to season and hoping each harvest would be enough to make it to the next one. Morrison had seen 1,000 farmers like Warren, good people, hard workers, but caught in the squeeze that was tightening across American agriculture in the late 70s. Here's what Morrison knew from the numbers. Land values in Washington County had jumped from around $200 an acre in 1970 to nearly $500 an acre by 1978. That sounded good if you own land, but it created a problem. Property taxes went up, and worse. It made expansion almost impossible for anyone who wasn't already big or didn't have access to serious capital. Operating costs had exploded. Diesel fuel that had cost 18 cents a gallon in 1970 was pushing 90 cents by 1978. Fertilizer had tripled in price. A set of tractor tires that might have cost $300 in 1970 was $1,000 now. Interest rates were climbing. Prime rate was over 7% and heading toward 8%. Farm loans were running 9, 10, sometimes 11% depending on the borrower's credit and the lender's nervousness. According to Federal Reserve agricultural lending reports from this period, the average dryland wheat farmer in eastern Colorado needed to borrow about $20 to $25 per acre for operating expenses. For 1,600 acres, that meant Warren should be looking at a $35,000 to $40,000 operating loan just to get through spring planting. But Warren wasn't looking at any loan at all. Morrison couldn't figure out. He pulled Warren's file after that meeting. It was thin, almost nothing in it. Warren had never borrowed from First National. Not once. Not for equipment. Not for operating expenses. Not for land. Not for anything. Morrison checked with the Production Credit Association office in Yuma. Nothing there either. Federal Land Bank? No record. He called Bob Jensen at the Farmers Co-op. Bob, Warren Kozlowski. He farm on credit with you folks. Cash account, Jensen said. Always has been. Pays when he picks up fuel or parts. Never carries a balance past 30 days. How much is he buying? Fuel? I'd say maybe 10,000 gallons of diesel a year. Not huge, but not small either. Parts? He's pretty conservative. Fixes things himself mostly. Probably spends $2,000-3,000 a year with us on parts and supplies. Morrison did the math. 10,000 gallons at 90 cents was $9,000 just for fuel. Add parts, fertilizer, seed, hired help if he used any. Warren should be tapped out before spring even started. Bob, how's he paying for all this? Check. Always a check. Always clears. Morrison thanked him and hung up. Then he sat there at his desk and tried to make sense of it. The agriculture loan business in 1978 was built on a simple model. Farmers borrowed in the spring to plant. They harvested in the summer or fall. They sold their crop. They paid back the loan. Then they did it all again the next year. It was seasonal lending, predictable, structured, but it required borrowing. Even farmers with equity in their land needed operating loans because everything had to be paid for up front. Seed, fuel, fertilizer, chemicals, months before any income arrived. Farmers who tried to cash flow their operations without borrowing were rare, and farmers who succeeded at it, almost non-existent. The margins were too thin, the capital requirements too large. So either Warren Kozlowski had money Morrison didn't know about, or Warren was about to hit a wall that would put him out of business before summer. Morrison decided it was probably the latter. Warren was too proud to admit he needed help. By the time he realized he couldn't make it without borrowing, it would be too late. Fields would go unplanted. Bills would stack up. The whole operation would come apart. Morrison had seen it happen before. Farmers who waited too long to ask for help. By the time they walked through his door, they were already drowning, and he couldn't throw them a rope that would reach. He made a note in Warren's file. Declined operating loan February 1978. May return when reality sets in. Be prepared to work with him. Then he moved on to the next application. He had real borrowers to worry about, but he kept thinking about Warren Kozlowski. March came. Spring planting started across Washington County. Morrison watched the tractors roll. He knew which farmers were planting on his money. About 60% of the agricultural operations in the county had operating loans through First National. Warren Kozlowski's fields got planted right on schedule. Morrison drove past one day, saw the white 2 to 155 pulling a cultivator across summer fallow ground. Smooth, steady work. Warren in the cab, window open despite the chill, working to feel like he had all the time and fuel in the world. Morrison couldn't figure out where the money was coming from. He mentioned it to his wife over dinner one night. There's a farmer out east of town, Kozlowski, turned down a loan. Now he's planning like he's got a blank check. His wife, Linda, who'd grown up on a ranch and understood agriculture better than Morrison sometimes remembered, said, "Maybe he does." "Does what?" "Have a blank check. Or close to it. Maybe he's not broke. Maybe he's just careful." Morrison shook his head. "You don't understand the numbers. Honey, nobody farms at many acres without borrowing. The capital requirements are too high." Linda just smiled and went back to her roast beef. But she didn't argue. She learned a long time ago that Jack Morrison didn't like being told he might be wrong about farming economics. April turned into May. Warren's wheat came up green and strong. His cattle looked good. He bought a used grain truck in auction in Sterling, a 1971 GMC, nothing fancy, but it ran and the bed was solid. Paid cash, $3,200. Morrison heard about it from the auctioneer, who banked at First National. Counted it out right there, 32 $100 bills. Didn't blink. Now Morrison was actively curious. Where was this money coming from? He started asking around. Subtly at first, then less subtly as his curiosity grew into something closer to obsession. The picture he assembled was strange. Warren lived in a modest house on his property. One bathroom, no air conditioning. Heated with wood stove and a propane furnace. His daughter was at Colorado State, yes, but on a scholarship, academic scholarship, full ride. Warren wasn't paying tuition. He didn't take vacations. Didn't buy new clothes. Didn't own a television. Someone at the co-op said Warren still had a rotary dial telephone because he saw no reason to pay extra for touch tone. So Warren was frugal, extremely frugal. But frugality alone didn't explain where he was getting tens of thousands of dollars to operate a farm without borrowing a dime. Morrison went to the county courthouse and pulled property records. Warren's section and a half was owned free and clear. No mortgage, no lien, nothing. The property tax records showed he'd paid $1,400 in taxes last year. Paid on time. No delinquency. Ever. Morrison pulled tax records going back to 1964, when Warren had bought the place. Bought it outright. No mortgage recorded. Purchase price was $68,000 for 960 acres. That was about $70 an acre in 1964, which was a fair price for dryland in Washington County back then. But where had Warren gotten $68,000 in 1964? He would have been, 29 years old? 30? Where does a 30-year-old farmer get that kind of cash? Morrison kept digging. Public records were his friend now. He was looking for liens, loans, mortgages, anything that would explain the financial picture. Instead, he found mineral rights. Washington County wasn't exactly oil and gas country, but there was some production, mostly natural gas from the Denver-Julesburg Basin. Wells scattered across the eastern plains, small producers, nothing spectacular, but enough to generate royalty checks for people who owned the rights. Warren Kozlowski's section and a half had 2 producing gas wells on it, not on the primary farmland. They were drilled on corners where cultivation wasn't practical anyway. Small producers, maybe 2,000 cubic feet per day each. Nothing that would make anyone rich. But Morrison did the math. At late 1970s gas prices, those 2 wells might generate $5,000, maybe $6,000 a year in royalty income. After taxes, maybe $4,000 net. That was nice. But it wasn't enough to fund a farming operation without borrowing. Morrison kept looking. He pulled court records, estate records, divorce filings, anything that might show a money trail. And then he found it. Warren's uncle, the one who'd sold him the farm in 1964, had died in 1976. Estate probate records showed the uncle had been worth nearly $400,000 when he died, most of it in land, property in Montana, Colorado, some rental houses in Denver. Warren Kozlowski was listed as one of 3 heirs. After estate taxes and legal fees, Warren's share of the inheritance came to roughly $115,000. He'd received it in September 1976. 18 months ago, Morrison sat back in his chair. $115,000. In 1976, that was enough to operate a 1,600-acre dryland wheat farm for 3 years without borrowing a dime, maybe 4 years if you were careful. And Warren was nothing if not careful. But there was more. Morrison kept reading. The estate documents showed Warren had inherited not just cash, but also mineral rights of properties in Weld County, 3 separate parcels with producing wells. The documents estimated the annual royalty income at $12,000 to $15,000. $12,000 to $15,000 a year in passive income. Morrison did the math again. With that kind of royalty income, Warren could probably cover most of his annual operating expenses without even touching the inheritance principal. The inheritance itself was a cushion, a buffer, money he could use to buy equipment outright instead of financing it, to smooth out bad crop years, to capitalize on opportunities when they appeared. Warren Kozlowski wasn't broke. Warren Kozlowski was probably one of the most financially secure farmers in Washington County. And Jack Morrison had sat across a desk from him and assumed he was desperate. Morrison felt something uncomfortable twist in his chest. It wasn't quite shame, but it was close. He'd made an assumption based on appearance, on behavior, on the kind of unconscious calculation bankers made 1,000 times a day. Old truck equals no money. Modest house equals struggling operation. Quiet farmer equals financial trouble. He'd been completely wrong. Now here's where the story gets interesting, because Jack Morrison's mistake wasn't just personal. It was professional, and it was about to teach him something that would change how he approached agricultural lending for the rest of his career. Let me give you some context about banking in rural America during the 1970s, because this matters to understanding why Morrison's assumption was both understandable and dangerous. During this period, agricultural banks were under enormous pressure. The boom years of the early 70s, when commodity prices spiked due to the Russian grain deal and export demand exploded, had encouraged massive expansion. Farmers borrowed to buy land, borrowed to buy equipment, borrowed to expand operations. Banks loaned freely because land values were climbing and crop prices were high. Everything looked sustainable. But by 1977 and 1978, cracks were forming. Commodity prices had fallen from their peak. Operating costs kept climbing. The farmers who'd expanded aggressively were starting to feel the squeeze. Some were already in trouble. Banks like First National were caught in a bind. They needed good borrowers, farmers who would actually pay back their loans. But they also needed to generate loan volume, because that's how banks made money. The temptation was always there to chase marginal borrowers, to make loans to farmers who probably shouldn't be borrowing more, but who needed the credit to survive another season. According to Federal Reserve data, farm debt in the United States had grown from about $53 billion in 1970 to over $140 billion by 1979. That's more than a doubling in less than a decade. Agricultural banks were sitting on mountains of farm debt, and they were starting to worry about what would happen if crop prices fell further, or if a drought hit, or if interest rates kept climbing. In this environment, a farmer like Warren Kozlowski, someone with no debt, strong equity, and proven ability to operate successfully, should have been exactly the kind of customer a bank wanted. But Morrison had let him walk out the door because Morrison had assumed Warren needed the bank more than the bank needed Warren. That assumption was about to cost First National something much more valuable than one loan. Here's what happened next. In June 1978, another farmer came to see Morrison. Earl Dinsmore farmed about 2,000 acres south of Anton. Earl was in his early 60s, had been with First National for 20 years. And he was in trouble, serious trouble. Earl had expanded in 1974 by an additional 640 acres at the peak of the land boom. He'd paid $475 an acre, financed the whole thing through Federal Land Bank. Then he bought new equipment to handle the additional acreage, a John Deere 4630 tractor, and a 7,700 combine, financed through his equipment dealer and backed by First National. The expansion had looked smart in 1974. But now, for years later, Earl was drowning. Crop prices had fallen. His operating costs had climbed. He'd had a hailstorm damage part of his crop in 1977. His debt service was eating up every dollar he could generate, and then some. Earl needed to restructure his loans, extend terms, lower payments, something. Morrison looked at Earl's numbers and realized there was no easy fix. Earl was over-leveraged. His debt-to-equity ratio was underwater. The land he'd bought at $475 an acre might be worth $500 now, but that wasn't enough equity to justify the level of debt he was carrying. Morrison had two choices. He could work with Earl, extend more credit, restructure the existing loans, hope the situation improved, or he could call the loans and force a liquidation before things got worse. Neither option was good. If he worked with Earl and things didn't improve, First National would end up owning a farm they'd have to liquidate at a loss. If he called the loans now, Earl would lose everything and the bank would still probably take a loss. Morrison tried to restructure. He really did, but the numbers didn't work. Earl needed someone to inject capital into the operation. Fresh money. A partner or an investor or something. That's when Morrison thought of Warren Kozlowski. He called Warren, asked him to come by the bank. "I've got a business proposition I'd like to discuss with you," Morrison said. Warren agreed to come in. This time, Morrison didn't push a loan application across his desk. Instead, he laid out Earl Dinsmore's situation, carefully, professionally, without violating confidentiality, but making the basic picture clear. "There's a farm operation that needs capital," Morrison said. "The operator is solid. The land is good. The problem is debt structure and a couple of bad years. If someone with liquidity want to come in as a partner or could provide financing outside the traditional banking system, it might be a good opportunity." Warren listened, asked a few questions, thought about it. "You're talking about Earl Dinsmore," Warren said. Morrison blinked. "I didn't say." "It's a small county, Mr. Morrison. There's only a handful of operations big enough to need the kind of capital you're describing. And I saw Earl's combine sitting in his yard with a for sale sign on it last week. Doesn't take a genius to put together." Morrison nodded slowly. "All right. Yes, Earl's in trouble. And I think he's a good man who made some decisions that looked smart at the time but didn't work out. If he had a partner with capital to help him restructure, he might be able to save the operation." Warren sat quietly for a long moment. Then he said, "What's Earl's current debt load?" Morrison told him. Numbers that made Warren's eyebrows rise slightly but didn't seem to shock him. "And the land value?" Morrison gave him the estimate. "So Earl's got equity, but he can't access it without selling, and if he sells, he loses everything." "That's about right." Warren nodded. "I'll think about it." 2 weeks later, Warren called Morrison, set up a meeting with Earl. "Let's talk." What happened next was something Morrison had never seen in 15 years of banking. Warren and Earl worked out a deal. Warren would buy the 640 acres Earl had purchased in 1974, buy them at the current market value of $500 an acre. That would inject $320,000 into Earl's operation, enough to pay off the Federal Land Bank loan on that land, pay down his equipment loans, and give him breathing room. Earl would continue farming all of his remaining acreage debt-free, except for manageable operating loans. Warren would rent the 640 acres back to Earl on a crop share basis. 30% to Warren, 70% to Earl. It wasn't charity. It was business. Warren was acquiring land at a fair price. Earl was getting out from under crushing debt. Both men would benefit if crops were good in the coming years. Morrison helped structure the transaction. First National financed none of it. Warren paid cash for the land. The deal closed in August 1978. Earl Dinsmore survived. His operation stabilized. By 1982, he was profitable again. Warren Kozlowski added 640 acres to his holdings. By 1985, he owned 2,600 acres outright. No debt, no mortgage, just land, cattle, and quiet competence. But here's the thing Morrison learned, and here's why this story matters. Morrison had assumed he knew what farmers needed. He'd assumed that someone who looked broke must be broke. He'd assumed that access to credit was the only thing that mattered in agriculture. He was wrong on all counts. Warren Kozlowski taught him that liquidity comes in many forms: cash reserves, mineral rights, royalty income, inheritance. Some farmers borrowed because they had to, others borrowed because it was strategically smart, and some didn't borrow at all because they'd found a different path to the same destination. Morrison also learned that the bank didn't always have the leverage it thought it had. First National needed good borrowers more than good borrowers needed First National. In a world where farmers like Earl were drowning in debt, farmers like Warren who had capital and no need to borrow were rare and valuable. The lesson Morrison took from this changed his approach to agricultural lending. He started looking past the surface, started asking more questions, started recognizing that farmers who didn't fit the standard profile might actually be the strongest customers a bank could have. Over the next decade, First National Bank of Akron built a reputation as a bank that understood the real economics of farming, not just the formulas in a loan manual. Morrison retired in 1992. By then, First National had one of the lowest default rates of any agricultural bank in Colorado. Warren Kozlowski farmed until 1998, when he sold his operation and retired to Fort Collins to be near his daughter, who became a professor at Colorado State. He died in 2006 at the age of 71. His estate was worth $3.2 million. Every penny of it went to his daughter and to scholarships for first-generation college students from rural Colorado. When Morrison heard about Warren's death, he went to the funeral, stood in the back of the church, and listened to people talk about a man who'd lived quietly, worked hard, and never needed anything from anybody he wasn't willing to earn himself. After the service, Morrison told his wife the whole story: how he'd assumed Warren was broke, how wrong he'd been, how Warren had ended up teaching him the most important lesson of his banking career. Linda, who'd been right all along, just smiled and patted his hand. "Sometimes the people who look like they have the least are the ones who have the most," she said. "They just don't feel the need to show it." Now, here's what this story teaches us about farm finance and why it matters even today when farmers face decisions about six-figure combines and $500,000 land purchases. First principle: liquidity isn't the same as income. Warren had liquidity from his inheritance and mineral rights. That liquidity gave him options that farmers depending purely on crop income didn't have. Modern farmers sometimes forget this. They look at their land equity and think they're wealthy. But if all your wealth is tied up in land and equipment, you don't have liquidity. You have assets. Assets are good. Liquidity is better. Second principle: debt is a tool, not a requirement. The agricultural lending industry teaches farmers that borrowing is normal. And it is normal. Most successful farmers use debt strategically, but debt is a choice. There are paths through farming that don't require maximum leverage. Warren found one of those paths. Not every farmer can replicate it, but the principle matters. If you can operate with less debt, you should. Third principle: appearances are worthless. Warren drove an old truck and wore mended clothes. That told you nothing about his financial position. In agricultural communities, especially in the 1970s when this story took place, there was a culture of frugality that had nothing to do with poverty. Many of the wealthiest farmers looked the poorest. Many of the most financially stressed farmers drove the newest trucks. The lesson: judge a farm operation by its balance sheet, not by what the farmer drives. Fourth principle: capital finds opportunity. Warren didn't advertise that he had money, but when an opportunity appeared, Earl's situation, Warren was positioned to act. He bought good land at a fair price. He helped another farmer survive. He did it without fanfare or attention. That's how capital is supposed to work. Quietly, efficiently, creating value for everyone involved. Now, let me address something that some of you are probably thinking. You're thinking, this story only works because Warren inherited money. What about the rest of us who don't have rich uncles? Fair question. Here's the answer. The inheritance accelerated Warren's timeline, but didn't change his principles. Warren was farming debt-free before the inheritance. He'd been cash flowing his operation since 1964. The inheritance gave him options. More land, more security, the ability to help Earl. But Warren would have been fine without it. Different trajectory, same destination. The real lesson isn't about inheritance. It's about financial discipline. Warren lived below his means. He maintained his equipment instead of replacing it. He didn't confuse revenue with wealth. He built reserves. He avoided unnecessary debt. Those principles work whether you inherit $100,000 or not. And here's the modern application. Farmers today face pressure to scale up, to buy the latest equipment, to expand operations, to compete with mega farms. The industry tells them that bigger is better. That leverage is smart. That efficiency requires maximum investment. Sometimes that's true, but not always. The farmers who survive the next agricultural crisis, and there will be another crisis, there always is, will be the farmers who remember what Warren Kozlowski understood. Liquidity matters. Debt is risk. Appearances don't pay bills. And the banker who thinks he knows your situation probably doesn't. So here's what I want you to think about, especially those of you who lived through the 70s and remember what it was like. How many Warren Kozlowskis did you know? How many quiet farmers who didn't advertise their success, but who were rock solid when everyone else was struggling? And how many times did someone make assumptions about those farmers that turned out to be completely wrong? Tell me in the comments, because these stories matter. The history of American agriculture isn't just about the big operators and the dramatic collapses. It's also about the people who did it right, who survived by being careful and smart and disciplined, and who never made the news because they didn't need to. This channel exists to preserve the real history of how farming actually worked, the economics, the choices, the consequences. Not the sanitized version where everyone's either a hero or a villain, just the truth about how people made it or didn't make it, and what we can learn from their experience. If you think that matters, subscribe, share this with someone who needs to hear it. And remember, the next time you see a farmer driving an old truck and wearing worn-out boots, don't assume you know their story. You probably don't. And that might be exactly how they want it.